insiders program for clients that purchase a certain amount of precious metals, and I've been updating them pretty much on a weekly basis. As far as the commitment of traders, there's the large commercials. This includes hedgers and the big bullion banks, and then there's the speculative, the specs they're called, and then small traders. And they're taking two sides of the same bet, basically. But the commercials are almost always net short. If you deduct the commercials longs from the shorts, you're left over with a balance that's net short. And the specs are almost always net long. And when these positions explode to a maximum, it means we're coming up near a peak usually, and the commercials are almost always on the correct side of the bet. They go the most short right near a peak, and then as gold and silver fall, they start to cover their shorts. Now, we had the greatest short position in history recently, and I'm looking for a chart here, but I don't see it in front of me, so I won't bother with that. But there were many analysts that got very bullish on gold and silver over the past several months, and I made some small purchases for myself. You know, I've got a precious metals dealership, but that's very separate from my own personal investing. And my own personal investing has been in physical gold and silver bullion for quite a while now. I used to have a lot of mining stocks. I sold those back in 2008 or 2010. I can't remember exactly when. But I've been strictly bullion for quite a while because I did a study on the difference between bullion and the stocks. And if you take the Barron's Gold Mining Index, which goes back a long ways, but you take it since gold became free trading in 1971, and gold has outperformed the mining stocks that are in the Barron's Gold Mining Index by 400% since then. So the mining stocks tend to give you leverage on the way up, but they have a little bit more leverage on the way down. And over time, that increases the losses. So I just went with bullion. But anyway, I was expecting it. I know that somebody dumped quite a few tons of gold onto the market when the price collapsed that day. And but you know, just after the market had closed, I made a significant. I do a monthly accumulation myself. I accumulate some gold and silver every single month. That's called dollar cost averaging, and it's one of the best ways to, you know, when the price drops, you get more for your currency. And I like it when the price drops. A lot of people hate this. They point at it and they say, oh, this is a manipulation and stuff. Well, yes, gold and silver are manipulated, and that's the only reason that you get the opportunity to buy gold and silver cheap, much, much cheaper than what market prices would normally dictate. If gold and silver were in the correct equilibrium, where supply and demand is being set into equilibrium by price, it's called the price discovery mechanism. If that wasn't being manipulated, there would be no opportunity. Gold would already be a few $1,000s an ounce and greater, and that would make it profitable for the mining companies. Right now, the mining companies are all having a very tough time, and that's a good sign. That means that there's going to be shortages in the future, and that means that it's going to go higher. Without the manipulation, it would never have you wouldn't have the opportunity of gold and silver one day exploding to the upside, and they are going to do that one day, and I have pretty much bet everything on it. So I really like these pullbacks. I hope it goes lower, and guess what? The commitment of traders reports they didn't cover that much of their short position last week. So that means that there is a lot more room for it to go lower than it is right now. So when I made my purchase on the day that gold and silver took the first big drop, I only spent. I had a certain amount of cash in reserve, and I only spent about half of it. And I'm withholding some more for another buying opportunity. I still will be doing my monthly accumulation on top of that, but every once in a while, I make a much larger than normal purchase. So I was actually expecting this. I did a video on it, I believe, last week, where I played some of my insiders reports from August 16th, I think, was when I drew some charts and I said, if it falls to this area right here, I'm going to make a purchase. And that it hit that target, and I made my purchase.
It's funny. You mentioned how the price of gold continually drops, and many people say, well, maybe it's a good time to sell. In America, our mindset is a little confused. I mean, if something goes on sale in a store, we run out and we purchase it. And that we see the price dropping. If the price drops, if we see gold or silver, the price drop, our minds immediately say we must sell this. And it's a very strange thing where we're a little confused on what we should do with these type of investments. And it's a very odd thing. And it's very tough to convince people, no, this is a very good opportunity right now where you should be purchasing a lot more of it, because to me, it's on sale. And I don't think we'll get this chance, anytime soon. It might go a little bit lower, but I mean, right now it's on sale.
Absolutely. And this is the typical public mindset, and it's completely opposite of the way they run the rest of their lives. And it's being ruled by your own fear and greed. And it's something that you have to battle. But, I started studying with the crash of the NASDAQ in 2000, I really started studying the markets and the global economy and monetary history. And by 2002, I made up my mind that precious metals was the place to be. I started purchasing gold. I've got a tube of gold eagles that only cost me $325 each.
Wow.
October of 2002. By April of 2003, I had discovered silver, and I started buying a whole bunch of mining stocks, and I caught the very last up leg where the mining stocks actually outperformed. If you create a chart that is the HUI index or the XAU index, the Philadelphia Gold Mining Index or Gold Bugs Index, and the unhedged gold and silver mining index, you divide those charts by the price of gold, you can find out how many ounces of gold it's worth. And if the chart is going up, that means the mining stocks are outperforming the physical metals. If they're falling, the physical metals are outperforming the mining stocks. And it was falling from 2006 until just last December, and then turned around, and the mining stocks have been outperforming the metals since last December. It was a very good buying opportunity. I'm not really sure if gold and silver continued down for, I've been expecting a deflationary recession, and so it is possible that we could see lower prices. And the fact that the commitment of traders, the commercials have not completely covered their shorts. They only covered about 15 or 20% of their short position. That says to me that things should go a little bit lower than this. But to me, I just consider it a buying opportunity. It's on sale. This is something to look forward to, not to fear. And another thing is, in my insiders report, I said this is similar. The precious metals market and the economy. This is similar to a bow and arrow or a slingshot. And the further you pull back on that bow before releasing the arrow, the higher and further that arrow is going to fly, and the faster it's going to go. And if you want gold to hit, if you're an investor in precious metals and you want gold and silver to hit spectacular highs, then you want this. We're in a cyclical bear market inside of a giant secular bull market. The bull market will resume one day, but this bear market, you want this grinding bear market to beat people to death and to make them feel like it's an impossible situation, and you want the maximum number of people to give up on this sector, and then it is ready for a spectacular charge. If this market had just kept on marching ahead like it had from the year 2001 to 2011, too many get-rich-quick people, and the dumb money jumps on board, and it wouldn't go nearly as high. The bull market probably would be over by now if it had just kept on marching along for the next 5 years, and we were up at $2,200. But I'm expecting prices well north of $5,000 an ounce. It's all because gold and silver are the only investment out there that has a central bank guarantee. The central banks they have absolutely guaranteed all of us, purely by the design of a debt-based fiat currency monetary system, that they will always print more and more and more currency. They will never stop. The currency supplies always have to expand infinitely into the future. Gold and silver are finite, and they are the other thing that is considered money. They are the other safe haven investment. Most investors are taught to go toward high-quality debt like U.S. Treasury bonds, but there will come a day when sovereign debt becomes very suspect, and at that point in time, everybody is going to be rushing toward gold and silver, and that is when when everything goes nuclear, when you see gold and silver become unaffordium and unobtainium.
Let's move on to the economy. The Fed, the U.S. government, the corporate media, they are continually telling the American public that the economy is recovered. I mean, they just put out the job numbers. They're telling us that everything is fine. They inched up a little bit, but they still tell us that everything is fine. And when you look at the real economic indicators, and when I say the real economic indicators, I'm not talking about manipulated unemployment or manipulated GDP. When we look at like retail and we look at housing, we look at, everything, corporate defaults and manufacturing, we see all that declining. From your viewpoint, is this an economy that is robust and improving, or do you see the opposite happening?
One of the things that I love to do is to sort of haunt the Federal Reserve's website. The St. Louis Fed has something called the St. Louis FRED, F-R-E-D, which is their research and educational site. And you can generate thousands and thousands you can generate charts from thousands of different data sets. And they collect information on everything. And you get, they also import the information from the Bureau of Labor Statistics and the Census Bureau and every other department of the government that generates statistics. And so it's all there in one place. And you can take these charts and you can put them in different formats where it's year-over-year percent change or whatever. You can pick different time periods. And one of the things that I've been showing in several of the last few months, I've been showing a lot of videos showing that, first of all, this is the weakest recession on record. It took zero interest rates and the creation of $3.2 trillion worth of base currency, and they bought the weakest recovery on record. And when you look at how things are starting to go negative on many of these indicators, you mentioned many of them, but you can also include things like the year-over-year change in government income, the number of rail miles. This is a very good measurement of the health of the economy. How much stuff is being shipped all over the country? So the number of rail miles is a very important indicator, and it's been falling. And a whole bunch of these data sets are showing that we entered a recession either last quarter or when they declare a recession, it's a trailing indicator. You have to have 2 consecutive quarters of bad economic news for them to declare that we're in a recession, which means the recession started more than 6 months ago. And so if you go to the Fed's website, you can get a glimpse into the future. And I believe that we're already in a recession. If we aren't, it's probably going to start in the next quarter. But I think we've already started a recession. And I think that, right after the elections, things are going to start getting worse, and that we're going to see a crash. And I don't think the Fed is going to be raising interest rates. I think they're going to be dropping interest rates again to zero. And if they have to go negative, they will. And there will be more QE. That's what will happen when the next recession hits. And here's something that most people don't know, is that since the beginning of the United States, there has been a recession roughly every 4.5 years. We are now, this recession is from 2009. And so we're 7 years into this economic expansion. It's the third longest economic expansion in history. And it's pretty soon it will become the second longest economic expansion in history, which means that the odds of going into a recession this year, or at least by next year, the odds of going into a recession before the end of 2017 are probably greater than 90% at this point. I haven't calculated them, but based on history, it's almost impossible that we will still be seeing economic growth in 2018. So we're right around the corner from this. And when it happens, if people take a look at my episode 7 of Hidden Secrets of Money, and they should watch episode 6 first, because it sets you up with a whole lot of information of why this next recession should be deflationary. And then episode 7 teaches people about the velocity of currency. In the long run, the quantity of currency determines prices, but in the short run, it's the psychology, it's the mood of the country that determines whether prices go up or down. And the mood of the country is what determines whether or not you go out to dinner and take your friends out and spend and have a good time and borrow currency and buy a house and buy a new car and a new flat screen TV. And every time you make transactions, the velocity of currency is how many times a single unit of currency, like a dollar, changes hands over a period of time, like a year. And the velocity, they added 400% more base currency. It took 200 years to go from $0.8 trillion in existence of paper dollars, the base currency. There was only 825 billion before the crash of 2008. And now there's 4 trillion. So they created another 3.2 trillion, 400% more, and put it on top of what we already had. That means they created 800 years worth of currency in just the past 6 years. And that's going to come back to haunt them. But it didn't cause retail price inflation. It only inflated a few asset classes. It inflated stocks, bonds, and real estate again, back into bubbles. And the reason that it didn't create any retail price inflation, or very little, it's actually more than they say it is. I believe that about John Williams' shadow government statistics and the pre-Ronald Reagan CPI. I think the truth is actually somewhere in the middle. But still, inflation is a lot higher than what they're saying it is. But with zero interest rates around the world and some negative interest rates, this is the market desperately trying to deflate, to set everything in balance once again. And the powers that be are all Keynesians. The world's central bankers, the people that run the global economy, believe in Keynesian economics. John Maynard Keynes, for any listeners that don't know who he was an economist during the 20s and 30s that came up with the theory that governments should have an elastic currency supply that can expand when there's an economic downturn, and the governments can do a bunch of deficit spending and create jobs to try and lift us out of the downturns, the recessions. But then they're supposed to contract it again after the recession is over, and they've never done that. But negative interest rates are proof that Keynesian economics does not work. But I believe this next recession will be deflationary, because what we've seen so far is they created $3.2 trillion, but the velocity of currency fell to almost exactly neutralize the inflationary effect of that $3.2 trillion. So they added 400% to base currency, and it did nothing, because most of it is sitting on the bank's balance sheets and it doesn't circulate. It's parked. However, the banks get to use that for fractional reserve lending during the daytime. And if you look at I've been generating a chart on the Fed's website for a few years now, showing I update it periodically, showing the Wilshire 5000 total market cap index. So this is the market capitalization of the 5,000 largest public companies in the United States. And that means that it's basically the value of the stock market. The 5,000 largest companies probably represent 98% of the value of the stock market. And when you overlay that with the creation of base currency, there was no correlation before 2008. But after the crash of 2008, the correlation is almost exact. This recovery was bought and paid for by driving up real estate and driving up the stock market, where this excess $3.2 trillion was given to the big banks that have been using this to gamble in the stock market. And the proof is that the rise of the stock market almost exactly tracks base money. The correlation is really scary. So, but I do think that this next crash, and we're due for another one. We had the crash of the NASDAQ. It was stocks in the year 2000. Greenspan lowered the rates to 1%, held them there too long to reflate the stock markets. And when you manipulate the free market, you can never predict what's going to come squirting out. There's always some unintended consequences that come squirting out, and he couldn't even see that he was creating a real estate bubble that like the world had never seen before. And so the next crash in 2008 was stocks and real estate. Well, now we're at the end stages of a 35-year-old bond bull market, and bonds have been pushed into a bubble. So the next crash that's coming up is stocks, real estate, and bonds, because real estate is also back into a bubble. This one's going to be worse than the previous crashes.
You're saying that this crash coming up is going to be a lot worse than what we saw in 2008.
Yes, and the popping of a bond bubble is very deflationary. The bond bubble did not pop. The bond bubble just marched ahead forward during the last crash. So yes, this is going to be much more devastating and most likely deflationary. However, all the world's central banks, they're Keynesians, and they've already shown their cards. Their answer is to print and take interest rates down. Well, they can't take interest rates down too much below zero without going to a cashless society and outlawing paper currency, because people will start, if it's costing you 1%, 2%, 3%, 4% interest to keep your currency in the bank, you're just going to buy a safe and keep it at home instead. Mm-hmm. And so as they go into this deflationary collapse, the only bullet that they've got is to print and print and print until deflation starts to give way. The problem is, if the public is scared, and this time, episode 7 of Hidden Secrets of Money shows that, the crash of the NASDAQ, the baby boomers still had 20 years to recover if they lost something. The crash of the global crisis of 2008, in which they saw their IRAs went down after the crash of the NASDAQ. They recovered back to where they were in 2007, but then with the crash of 2008, their IRAs went down even further than they had gone in the crash of the NASDAQ. And now they've recovered. If you inflation adjust it, the stock markets are still 10% down from the year 2000, and that's using the CPI, which I like to call the CP lie. So the markets are really down even more than 10% when you're comparing them to how much goods and services you can actually buy. And this next crash is going to be even more devastating, but the baby boomers do not have any time left to recover. So they are not going to go out and borrow and spend after this next crash. When they see their retirement accounts shrink again, they are just going to get very scared, and they're just going to save. They're going to pay down debt and save because they've been punished 3 times in a row for investing.
So those baby boomers who are dependent on their pensions, on retirement, what happens to them? Will they lose their retirements?
Yes, they're going to have to work into their 70s and 80s, and they're going to have to try to, the average IRA or 401k has $10,000 or less in it. That's a month's worth of living. That can't get anybody by for retirement. So the baby boomers, this is something that has, since we have had central banking and Keynesians have been running the show. If you look at interest rates for the history of the United States, once we had the Federal Reserve, we had ultra low interest rates during the Great Depression. We had interest rates that had never been seen in history during the 70s and the early 80s, where you went into the high teens. That's the type of thing that normally is accompanied with the beginnings of a hyperinflation. You don't have, Fed funds rate hitting 19%. And after that, we had a 30-year period, and a lot of it under Alan Greenspan, where we were in a disinflationary era. Every year there was less inflation. Every year interest rates came down, and this encouraged borrowing and spending because you could take you could do a refi on your home, refinance it, take cash out, remodel your kitchen, put on an addition, put in a swimming pool, buy an SUV, or take a vacation with this cash out refinance. And then 5 years later, interest rates were so much lower, and the value of your home went up, that you could then do it again and actually lower your payments each time because interest rates had fallen. And so this trained an entire generation of baby boomers to borrow and spend. And a lot of it was Alan Greenspan holding interest rates just slightly below what a free market would dictate. And that has created an entire generation of reckless borrowers and spenders. And that's the reason they don't have anything in their retirement accounts. They've got basically a month's worth of living expenses. If they get frugal, they might be able to stretch that out to 3 or 4 months, but that's not a retirement.
So what about the generation, the individuals that are 30, 40, 50 who are still working?
Yeah.
I mean, in
feel
2008,
because taxes are only going to go up, and they are going to have the burden of carrying all these baby boomers on their back, and it's the largest sector. It's 75 million people that need to, are retiring now and will be retiring for the next decade.
So will those? I mean, they have to carry the baby boomers, but will there be jobs? I mean, back in 2008, many corporations laid off many individuals. Companies closed down. If this crash happens and it's worse than 2008, what are all these people going to do? Because last time we saw in California and many other places, people just walked out of their homes because interest rates started to rise. They had a variable rate interest. So this time around, what happens?
Well, this time around, a lot of baby boomers do end up homeless, and this time around, the younger people that you're talking about, a lot of those jobs do vanish, and it's one of the things that is also happening is government is creating so many laws and so many rules that it's very, very difficult. I left California because it was just an absolute nightmare trying to run a business in California. It causes many sleepless nights, and it whittles away at your health, and it's the government's fault. They are destroying prosperity by trying to promise everybody everything and trying to protect everybody. Right now, if any business in California is guilty until proven innocent when it comes to employee claims, when it comes to the government with OSHA or the labor board or taxation. And so you can't just ignore something or blow it off. They'll just shut you down and take your business away. It's become very, very difficult, and that means that there's going to be even less jobs. The more they, in the state of Washington, they raised the minimum wage up to $15 an hour, and what happens is somebody invents a hamburger flipping machine, and a guy dropping French fries into some hot grease and pushing a broom at McDonald's. Those jobs exist so that somebody can get an entry-level job and learn how to show up on time and how to work with other employees and your employer and get some experience. They're not meant to give you a living wage. You're supposed to be living in an apartment sharing an apartment with 3 other people, to get by, and you work your way out of that. Those jobs are for the high school dropouts. And what happens when you see people say, oh, well, that's not fair, we have to mandate a minimum wage, immediately you see youth unemployment go up and you see a minority unemployment skyrocket. So it's minimum wage is a very discriminatory, mean practice. The market sets things into perfect equilibrium. You will have maximum employment if you allow the free market to do it. But the government doesn't allow a free market. We have a there is no such thing right now as a free market. There is no such thing as capitalism, capitalism is getting blamed for all of these problems that are created by cronyism. Big business that is allowed to lobby government and get special rules put in place for them that don't apply to anybody else. And so, we're going through a cycle right now where you asked about the younger generations. It's going to be tough. Unemployment will be high. It'll be hard to get those jobs.
Many people wonder, everyone talks about the crash and the collapse or the crisis, whatever word you want to use. How long will this last? I mean, when people say, okay, the whole system's coming down, it might come down this fall, maybe in the spring of 2017 or whenever it does, how long can people expect things to be bad?
Well, if the world's central bankers were not Keynesians, I would be agreeing with Harry Dent. My guest in episode number 6 of Hidden Secrets of Money is Harry Dent. Mm-hmm. And we discuss many of the reasons that this next crash is definitely going to be deflationary. And I have been saying this since I wrote my book, which was written from 2005 to 2007. It was just updated recently for 2015. But everything I wrote in there has been coming true. I said that we would have the threat of deflation, to which Ben Bernanke would overreact and do a big helicopter drop of currency, which would cause a big inflation. It didn't cause an inflation of retail prices. It caused a huge inflation of asset prices, because we're back into bubbles in stocks and real estate and bonds now. Then we would the next crisis would be real deflation that hits us, contraction of the currency supply. And then the world's central bankers would overreact. I do not think that the deflation that is coming will last that long. What will happen is they will print and print and print, and velocity will continue to drop as all of the people that they'll try anything to get cash into the hands of the public so that they'll go out and spend. But the scared baby boomers, a quarter of the U.S. population and the largest sector of the workforce, is going to, because their anxiety levels are very high, they're going to save every extra dollar. And when you save dollars, they don't circulate. When they're sitting in a savings account, they're parked. That means velocity falls. And that will continue until they get enough saved to where they feel like they've got enough for a retirement, and they can actually go out and buy the latest cell phone or replace their aging car or get a new flat screen TV. This will also be accompanied by a whole lot of people trying to downsize. Their kids are now gone. They're off to college, or they've got their own families, and they don't need a 4 or 5 bedroom house anymore. They, have this dream of getting a condo on the golf course. So you've got a real estate crash accompanied with a whole bunch of people that don't need a McMansion anymore, and it's the largest sector of the population. So I think you're going to see something rather spectacular, but the central bankers, the Keynesians that are running the show, which, by the way, they are wrong. Their theories are wrong. Keynesian economics isn't even remotely plausible. But they are going to print and print and print and print until deflation gives way, but that will happen after a bunch of currency is saved. And we have some very good examples of this, and I had data from the First World War in Germany. And, they expanded their currency supply. They added 400% to their currency supply during the war, and there was zero inflation during the war because there was a lot of anxiety. People didn't know what tomorrow was going to bring. Their sons were being killed. They stashed every extra mark that was printed, and it didn't circulate. And then the anxiety was lifted with the end of the war, and they had a 900% hyperinflation in 14 months. It was a hyperinflation that no economists have ever talked about. It was not the 1923 hyperinflation that everybody, it's known as the Weimar hyperinflation, but I'm talking about the 1919 to 1921, February of 1921, 21, hyperinflation, where everybody lost 90% of the purchasing power of all that currency that they had saved. Once it came out of hiding, and you had this increased currency supply plus increased velocity. People started spending. They had put off all their purchases for 4 years during the war, and they needed goods and so on, and they were sick of being poor, and the anxiety is lifted. They know what the future is going to bring, and they started spending, and prices went up ninefold. It's in the Hidden Secrets of Money, number 7. And I encourage people to watch it, because this is all based on looking at monetary history and the current economic situation and psychology and demographics, and adding all of those things together to try and predict the future. And so far, everything I wrote in my book, you can sort of check it off like a list. These things did happen, and what I predicted that did not happen, I believe, has not happened yet.
It's on its way.
Exactly.
Yeah.
It's coming down the road at us, like a 18-wheeler coming out of the fog.
Yes. Mike, I really appreciate you taking the time out, and I appreciate you coming on the X22 Report Spotlight. Once again, how can people see your work? You also have a YouTube channel, correct?
Yes, the YouTube channel is, I believe it's Gold Silver Mike Maloney, but just Google Hidden Secrets of Money or Mike Maloney, or do a search on YouTube for Hidden Secrets of Money, and it'll be the top hit. HiddenSecretsOfMoney.com.
What I'll do is I'll put all the links at the bottom of this video, so it makes it a lot easier for people. They can just click on it and they'll bring them right over there. Once again, I really appreciate you taking the time out, coming on the X22 Report Spotlight. Thank you very much.
Thank you. It was great being here.